Welcome to the Wealth Studying Podcast. This is episode 466. Today is March 30th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, hey, this week the market took a tumble again, confirming the correction that we're in. In this episode, I'm going to talk about some discrepancies with what we see in terms of the data and the technical fundamentals and compare them to some of what we're seeing in the headlines. I have purposely not put out a podcast over these past few weeks because regardless of what you're hearing in the media, whether it's pro or con, or regardless of what the market does on any given day, whether it's going up or going down 1% or more, I don't think it's done any good to try and evaluate the movement because it really all comes down to one thing. On any given day, the market is going to go up or down based on what comes out of President Trump's mouth. If he says something the market likes, it goes up. If he says something the market doesn't like, it goes down. The problem is, well, there's multiple problems, but I guess the two key problems are, number one, you never know what's going to come out of his mouth because he could literally say one thing in the morning and say something completely different in the afternoon. And if that weren't troublesome enough, the real conundrum isn't that he'll just backtrack or change his mind or flip-flop. With impunity, he can out and out call into question whether he even said something.
Did I say that? I can't believe I said that. Next question.
Now, while that's certainly been a problem for creating a lot of turbulence and volatility in the market and for throwing off everybody's predictions and models, the silver lining I see in the whole thing is that you just don't believe anything he says. And hey, I'm not picking on Trump. He's a politician. How do you know when they're lying, right? When they're moving their lips. So just put it aside as you would with any media narrative. Go back and remember wealth building principle number 8. It's about identifying and recognizing propaganda. Just that Trump has taken it to a whole new art form.
Did I say that? I can't believe I said that. Next question.
But I think, again, there's a silver lining in all this. It should just teach you to totally ignore what's being said in the media. And again, this is both pro and con, for and against some of the things that Trump says or that he's working towards. Because again, whether you love him or hate him, put the emotions aside and try and focus on what direction the market is moving in. I've been trying to build the case that we are in long-term trends that are going to take place more or less regardless whatever politician says. And for the most part, the politicians that we have are simply symptoms of the trends themselves. Hey, there is a caveat to all this, though. Some of the things that Trump says and does do get results, even if they're not necessarily the results that you think that he wants, or if they're counter to what he's talking about. And I'm not sure where he's going to go with tariffs overall. I know industrial policy was increasing in the United States, going at least all the way back to the Obama days. The United States, for at least 15 years, has realized that China is an adversary, and the manufacturing base of the United States has been eroded to the extent where it's detrimental to national security. So all this was moving in a particular direction anyways. It's just that Trump has thrown in a lot of element of chaos and uncertainty that, things could be dealt with in a much better way than they are. But even having said that, things are moving in the long-term interests of what the United States government has been wanting. And this is a point I made in a blog post I did a week or so ago, where I mentioned that every president since Truman has been trying to get the Europeans to spend more on their own defense. Trump tried that too in his first term, and he failed then, just like every other president going back to Truman has failed. And I'm talking about Europe broadly, not specific states. I mean, obviously, the countries bordering Ukraine, ever since the war, have really stepped up their spending on defense. And that even includes some countries joining NATO that had been, neutral for the last 80 years. But in any case, the core of Europe, and specific to a country like Germany, which has been a manufacturing powerhouse, but has really put defensive expenditures on the back burner, especially in the last 30 years. Well, what have they done all of a sudden? They're not only stepping up defense spending, they're going to raise $1 trillion in debt, and this is a country that used to have a debt backstop that didn't want to run budget deficits. but they're committed now to spending unbelievable amounts of money on defense. Now, would that have happened if Trump wasn't so chaotic and had a madman managerial method? I don't know. Again, if you love Trump, you're going to give him credit for it. If you hate him, you're not going to give him any credit at all. Bottom line is, over the last month, as the U.S. market has declined, one of the markets that's done really well has been Germany. And again, this is a conflict of real rational and reason. Because if Trump's tariff policies are truly what's detrimental to the current stock market condition, and if that's going to cause the U.S. economy to go into recession, then you can't just decouple the American economy from everywhere else, especially when we do import so many products from countries like Germany. So whether we stop importing cars from Germany either because Trump raises a tariff on them or because we just go into recession in and of economic conditions and stop buying all those BMWs and Mercedes, or if it's a combination of tariffs and a recession, well, either way, if the U.S. market dries up, well, that's not good for Germany and other exporters into our market, right? So if we're really headed over the abyss, then things can't be rosy for Germany either. So why is their market up so much in the last month to 6 weeks? Well, again, a lot of it has to do with the deficit debt spending that they're committing to increase their defense and to build up old rundown infrastructure. So, hey, short term, it's a great trade. But long term, does that really make any sense? I mean, Germany specifically and Europe in general suffers from 4 major problems. They can do all the debt spending they want to build up infrastructure and to reinforce their military. I'm not saying they don't need those things, but long term, what they're talking about spending on now doesn't impact the 4 things that have caused them to be in decline, certainly since the pandemic, and really to be having a stagnant economy since the great financial crisis of 2008, 2009. It hit Europe a little later. But overall, there's really been limited to sclerotic growth in Europe over the past 15 years. And it comes down to this, and again, specific to Germany. Demographics, their demographics are out of favor. They have far too many baby boomers that are retired and living on the social welfare system, and they haven't had enough Gen Xers and millennials to support that, and it's continuing to get worse. They have a very fragile energy system. They are not energy independent by any stretch of the imagination. They are major importers of almost every form of energy. And again, Germany specific, this has been a really big hit to their manufacturing base, especially since the Ukraine war, where their, electrical costs are something like 3 times what we pay on average for in the United States. And that gets to the next problem. That industrial base has been declining, not only because of higher energy costs, but also because they're losing a lot of their export markets to the Chinese, both in terms of the Chinese not importing as much from Germany as they had in the past, and in terms of the Chinese stepping up their exports and being able to take over and gain market share in markets that the Germans had really dominated. Things, for example, like the international market for automobiles. The Chinese, with their cheap electric cars, BYD, they're really making a dent in overall international car sales. That's hurting companies like Volkswagen. And at the same time where Germany is losing its industrial base on multiple fronts in terms of not only, getting beat out in competition by the Chinese, but having restrictive and repressive energy costs, Germany, again specifically, and Europe in general, have failed over the last 30 years to build a significant tech sector. I'm looking at a list right now of the top 20 tech companies in the world, right? The global tech leaders. Only 2 companies on that top 20 list are European. That's ASML, which is Netherlands, and SAP, which is in Germany. But the fastest growing sector of the economy for the last 30 years, and what's going to carry us through the next, 30 years, is technology. And the Europeans have just gotten far, far behind the Americans and the Asians. Those factors, those 4 factors, don't forget those. We're going to come back to those. But let's look at the market. Right now, the S&P 500 is doing something very unusual. It's putting in a double bottom. While the double bottom pattern in and of itself can be quite fascinating, what I find interesting about the setup that we're in right now with the S&P 500 is that the apex of the double bottom, this would be the high point between the two bottoms. And again, that second bottom hasn't been put in yet. We don't know if it's going to go back and test the lows that occurred around March 13th. That was S&P 500 of around 5,500. It very likely could get to that level and bounce off of it, or it could break that support and go lower. If it were to go lower, dropping all the way down to 5,000 wouldn't be out of the question. Now, I personally don't think we're going to get that low. I think if we did get that low, it would probably bounce off at that point because there is a great deal of support, and also fundamentals really just don't justify that low of a movement in the S&P 500. Again, that's not to say that a shock to the system wouldn't drop at that low, but as we stand right now, profitability for companies are pretty much still holding up. We're going to get into those first quarter earnings coming out in the next few weeks, and so through April and into May, we'll get a much better read on how corporate profits are holding up. But again, despite all the noise and static you hear about tariffs and all the uncertainty, we're not seeing a profit recession, not yet anyways. So, again, for us to get drastically below that 5,000 point, I think that's what we'd have to see, and it just doesn't look like it's on the horizon. Again, looking at the data, looking at the leading economic indicators, the talk about future orders on the books, and overall manufacturing capacity. All those things still look pretty positive. But again, keep an eye on it. Watch that previous low of around 5,500. Let's see if it can hold there or if it does go lower. If it goes lower, we'll talk about it at that point. I suspect it either won't get that low or it will bounce from there, again, depending upon what Trump has to say that particular day.
Did I say that? I can't believe I said that. Next question.
But beyond that apex, the high point between the two double bottoms, what's interesting about that is that's right around the 5750 level, right? Pull up a chart of the S&P 500 and take a look at it. What's interesting about that number is that is pretty much sitting right on the 200-day moving average. And that apex on a double bottom is always the trigger point that technicians look for a breakout, right? They wait until the price gets to that breakout level, and then they all jump in, and of course that's why it breaks out. It's sort of a self-fulfilling prophecy. But the bottom line is there is a great deal of support at that level, which correspondingly is resistance. But if we can break through that, that would be not only the apex of the double bottom, that would also be a breakthrough up above and through the 200-day moving average. And since the 50-day moving average has been in decline, they're not that far apart. So it wouldn't be hard to assume that you could get a real big follow through and some enthusiasm that could take the S&P 500 all the way back to its 50-day moving average, which is right around 5,800 or so. That, incidentally, is where a lot of analysts have moved their projection for the end of the year back to around 5,800. As the market was going up, they kept raising it. Now they're moving it back. But I do think 5,800 is a pretty solid number. And as I look at the overall performance of the S&P 500, although it is down 10%, or a little less than 10% right now, it had gotten down to 10%. It tried to recover. That relief rally failed. It failed pretty much at that 200-day moving average. That's where the apex is. It's moving back down now. We're going to watch that. We're going to see if it can hold or how low it goes below 5,500 before it recovers. And then we want to watch that apex again, that 5750 level. What gives me encouragement that the market is holding up.
Did I say that? I can't believe I said that. Next question.
Is that, again, despite all the volatility and the negativity you hear in the media and all the bad reporting, about how a recession's around the corner, about how we're, headed for a stock market meltdown, if you look at the volumes, especially the volume over the last week when we had this failure at the 200-day moving average again, volumes are all below average, and in some cases pretty much significantly below average. That tells you that there isn't a great deal of panic selling going on. Okay, the corollary to that, if you want to be glass half empty type person, is that it also tells you there's not a lot of enthusiasm to buy the dip. But that's what we're watching for. We're watching for that second bottom that comes in, and if there are dip buyers that come in and buy it and drive it back up above that 200-day moving average. But so far, the good news is there's no panic selling. And generally, that panic selling is what puts you into the downward spiral. From that standpoint, the market's holding up. It's not as volatile as you would think. And again, looking at the volatility gauge, the VIX, shockingly, the VIX isn't spiking. Yes, it's elevated. It's closed out this week at like 21 something. But again, it's in the 20s, the low 20s. Whenever we see major capitulation and fear and all the weak hands throwing in their cards, the VIX spikes up to the at least 30, if not into the 40s, 50s, or 60s. We're seeing a very muted VIX volatility right now, given all the negative news and all the uncertainty and all the craziness that comes out of Trump's mouth.
Did I say that? I can't believe I said that. Next question.
I think that's good news. And what I think is even better news is that we're finally seeing, and this is after 2.5 years of way overperformance of the Mag 7 in the S&P 500 and their dominance, we're seeing that fading away. And it's not just that the Mag 7 have gotten weaker, but it's that the other stocks, right, the other 497, they're getting stronger. If you compare the standard S&P 500, which is over-dominated and overrepresented by, 7, 10, a dozen or so stocks, the real big name, micro-cap stocks, year to date, that's being outperformed by the equal weight S&P 500. I put this up in charts occasionally over at investablewealth.com. You can see what I'm talking about. The bottom line, though, is year to date, as bad as the market's been, okay, and I'm not talking peak to trough, but year to date, the broader market, the equal weight S&P 500, is only down about 2%. Again, pretty incredible given all the volatility, all the negativity, and the fact that overall the S&P 500 is down about 9 or 10% from its recent peak, which was, it's hard to believe, it was put in just 6 weeks or so ago is when the peak for the market was put in. And even from there, from the peak, the broader market, the equal weight S&P 500, is down about half as much from its peak back in February compared to the 9 or 10% or so of the official S&P 500. So that shows that under the surface, things maybe just aren't as bad as all the negativity that's created in the media. And maybe, just maybe, all the negative investor sentiment is actually a good contrarian indicator for possibly this is a time to buy or at least hold and stay in the market. Another thing to look at is if you step back from just focusing on the big companies in the S&P 500 is how are the smaller companies doing? Well, the mid-cap companies, surprisingly enough, on a year-to-date basis and even peak-to-trough basis so far from 52-week highs, the mid-cap stocks are pretty much in line with the overall performance of the S&P 500. Down maybe a little slightly, a little bit, but you'd expect that. You'd expect smaller companies to be less stable than the bigger ones. But again, mid-cap companies really holding their own right now. That's a really good sign. And what I like about the mid-cap companies that's generally an area where they don't get overpriced, and when we do go into a recovery, they tend to really outperform. So take a look at that. You can track something like that using a ETF MDY. That's Mike Delta Yankee. And then finally, really looking at the small companies, and these guys, I always regard them as the canaries in the coal mine. They're the first ones to really suffer and suffer badly when there is a market downturn. This is no exception to that. Now, what's interesting about the Russell 2000, the small caps, being that canary in the coal mine, they are down big time from their 52-week high. And they're right at that official bear market indicator of being down 20%. They're down right now about 18% from their peak. But what's interesting is that peak was way back in December. Actually, it was in November, I think. If you look at them on a year-to-date basis, they're only down 9%. So if the small caps are the canary in the coal mine, they were giving us that indication 4 months ago. And they too, likewise, are putting in a shorter near-term double bottom here. It'll be interesting to see where they bounce off of. They're sitting right now at a great deal of support, and that support level is their long-term moving average. That's that 1,000-day, 4-year-ish type long-term moving average. That's always a key level to see if support can hold at. Now, even if it doesn't hold, that isn't the end of the world because literally from about the spring of 2022 until the end of 2023, the small caps were ping-ponging above and below, and sometimes significantly below that long-term moving average during that period. That's why I was very concerned that we would see a recession in 2023, because that final low for the small caps, again, wasn't put in until like November, October timeframe of 2023. But we're nowhere near that kind of decline right now. And again, this is after all the chaotic management we're seeing come out of the White House.
Did I say that? I can't believe I said that. Next question.
And again, too, I guess the big point of the small caps, they made their decline back in like November, December, which also, if you look at specific sectors, industrials, materials, mining, those sectors and many of those big companies have been in decline since fourth quarter of last year. So as much as Trump's crazy talk...
Did I say that? I can't believe I said that. Next question.
And flip-flopping back and forth with things like tariffs is not giving certainty to the market. A lot of these sectors were in decline long before that occurred. So I think the case can be made there that we're in more of a traditional business cycle pattern than just specifically the tariff uncertainty. And either way, remember that tariff uncertainty can go away tomorrow. And if things do lighten up and we do get some kind of reassurance on where tariffs are going to go, and if this business cycle has already been in decline for 4 or 5 months, and if the Russell 2000 is already at that long-term 4-year moving average that it traditionally bounces off of in a low cycle, then maybe we are closer to a recovery than we are to the S&P 500 dropping all the way down to 5,000. Some other indicators. These are market indicators, not just nonsense made-up investor sentiment surveys or GDP predictions from the Atlanta Federal Reserve. Hey, I'm not even going to get into that. If you've seen any of the news over the last 3 weeks, you've seen major commentary that we're headed to a recession because the Atlanta Federal Reserve is predicting negative GDP for first quarter that we're in right now. Listen, there are so many things wrong with that projection, some of which they've come out and openly corrected in saying that, well, it's really based on all the gold imports that came in to get ahead of potential tariffs, and that's what skewed the numbers. And listen, that number is so wrong and so highly politicized right now, it almost makes me question ever wanting to use that kind of an indicator again, because it is literally 180 degrees out of sync with virtually every other forecast, including the Federal Reserve Bank of New York's GDP forecast. And I don't mean a little off. I'm talking literally 180 degrees in the opposite direction. And that is the source for a lot of the negative news you're hearing. And when you get hit with that type of news, then of course they do investor sentiment surveys, and the investors are pessimistic because they hear bad news and they worry about increasing inflation. And then you know what? When the data comes out, it isn't that bad. PCE, core PCE came out this week. The market, did have a major drop on it when it saw the numbers. But listen, we went from expected rate of inflation of 2.7 to the real number being 2.8. Well, what does that mean? It doesn't mean anything. I mean, we're talking 0.1% of 1% to begin with, but even with that, so the economists that estimate it were off by 0.1% of 1%. Is the number even real to begin with? What will it get revised to next month or the month after, right? I mean, these are the same economists that are telling you in Atlanta that first quarter GDP is going to be like -2, while the economists at the Federal Reserve in New York are telling you it's going to be positive, 2.6. Yeah, let me tell you, my grandfather, he was an Italian immigrant. He had a 3rd grade education. He was probably one of the smartest men I've ever met. So he lacked education, but he was highly intelligent. He was just a poor immigrant guy, but he had a lot of common sense. And when he saw things like this, he had a technical term for it. In his broken English, he would call it bullshita. Take that for what it's worth. But again, all the fear and panic about rising inflation, and specifically with the PCE number that came out this week, well, do you know where the 10-year Treasury closed out this week? right? With all these worries about inflation, with higher than expected core PCE rates, 10-year Treasury is down to 4.25%. In January, the 10-year Treasury was at 4.8, and there was a lot of fear that we were going to 5% or beyond. And yet, with all the inflation being as sticky as it is, and supposedly all the concern about it, we're back down to 4.25. That should tell you something about where bond investors really think inflation's headed. Don't get me wrong, I'm not saying there isn't inflation. I've been saying for 4 or more years now that we're just not going back to the rates that we saw in the previous 15. For 20 years, we were at or below 2% inflation. That had a lot to do with technological advances, with digitization of the economy, and really had a huge deal with cheap imports coming in from China. Remember, China joined World Trade Organization in 2000, 2001. But that's what's deteriorated with global trade. Peak globalization is over. Manufacturing rates in China are higher because they too suffer from a demographic decline. They don't have cheap labor anymore. And so no, I don't think we're going back to that 2% or below rate of inflation rate. I think we're going to be more in that 2 to 3.5% rate, with or without tariffs. But even with that, 10-year Treasury is at 4.25%. Treasury rate shouldn't be at 0. Investors should be able to get at least a little bit of return on their money for saving it. We were in an aberration since the financial crisis and even beyond. It started with Greenspan in the early 2000s. It got worse with Bernanke during the financial crisis. It got even worse with Yellen during the pandemic and post-pandemic. 4.25 on the 10-year Treasury is very reasonable. And to me, even with all the uncertainty of other things, having a 4.25 10-year Treasury is a sign of stability. And it's just not Treasury rates. As you heard me talk about in previous episodes, the dollar is holding up. Yes, it's down from its peak, its short-term peak, and from a historical record, again, over the last 20 years, the dollar has been significantly weaker from where it is right now. The dollar is holding up extremely well at a time when we do see out-of-control prices on things like gold and silver, and even copper has really moved lately. But again, remember what I said about the mining industry, how it's been in decline since fourth quarter of last year? And you have to ask yourself, if higher copper prices are really going to stick, then why aren't the copper mining companies having better stock performance? That's a rhetorical question. But listen, the dollar's holding up, 10-year Treasury is stable and reasonable, and even while copper here has recently gone parabolic, what's interesting is the stability we're seeing in oil. Again, I've talked about this before. In the post-pandemic recovery, the base case for oil was right around $80. We consistently saw oil in the 80 to 90 range. It had, gotten crazy, I think 115, 120 at one point in 2022, but then it settled down, and you consistently had that upper end of $80 to $90, and then things were settling in on 70, but right now we're holding at just under 70. And this is a two-edged sword here. Number one, oil prices at under 70, when Trump is talking drill baby drill, and when OPEC is talking about increasing oil supply, to be able to hold at or below 70 is pretty amazing in and of itself when you think that maybe all the supply is going to come online. Number two, if inflation were out of control, you would see higher, much higher oil prices. And when you really compare oil prices on an inflation-adjusted basis, think about how cheap they are. Oil today, right, from a historical perspective, oil today is the same price that it was in July of 2005. Think about what a dollar was worth in 2005 and what it's worth today, and yet you're paying the same amount for a barrel of oil. Oil's holding up extremely well in the face of inflation. The other side, that two-sided edge is, and this is in support of the economy, if we are seeing a major collapse in the economy because a recession's right on the horizon, well, when that happens, oil prices fall apart. Remember during the pandemic, the initial phase of the pandemic, oil literally got below zero because demand shut off. So oil is quite stable right now. It's shockingly stable. Okay, in any case, this is where I want to close out. Remember I talked about the 4 problems that are specific to Germany and general to Europe? Well, those 4 issues are what keep me optimistic about the United States, because regardless of all the problems we have and all the uncertainty and all the Tweedledum and Tweedledee.
Did I say that? I can't believe I said that. Next question.
The United States remains a powerhouse. From a demographic perspective, we have a millennial age population that is enough to support our social welfare network to get the baby boomers through retirement. That's something that most countries don't have. And while we do have declining demographics overall, the United States consistently has the ability to bring in and attract talent from around the world if and when we need it. So demographically, the U.S. is as good or better, I believe, than any other part of the world. Energy, right? That's the other major problem of Europe generally and Germany in specific. The United States is a global powerhouse in producing not only fossil fuels, but other forms of energy as well. And as we move in the direction of going more nuclear, which isn't going to happen for, who knows, 10, 20 years down the road, but we have so much inexpensive, readily available natural gas that we're going to bridge that gap better than I, again, believe, than any other region of the world. The third point was technology. That list of the 20 companies I said that were global leaders in technology, only 2 of them were European. Well, 14 of them are American. America has dominated in technology, especially in the last 30 years, and we're going to continue to dominate for at least the next 10. Remember all the skerfuffle you heard about DeepSeek, 6 weeks ago? DeepSeek, the Chinese supposedly low cost, low development cost AI chatbot was going to take over the world, right? It was going to kill the value of NVIDIA and Microsoft. And, well, have you even heard that mentioned in the last week or so? The U.S. dominates with technology. So that's those factors, 3 of them so far. Demographics, energy, technology. The 4th factor affecting Europe and specifically Germany is the loss of its industrial base to China. Well, the U.S. has already lost that battle. We've been hollowing out our manufacturing base for 60 years. So out of Europe's 4 weaknesses, we share 1 weakness with them. However, we've already lived through that destruction of our manufacturing base. We've come to the conclusion that our national security rests on the fact that we have to at least have a minimum threshold of an ecosystem of manufacturing. Ultimately, I think that's a lot of what Trump is trying to achieve with his tariffs, and that's the same thing that we've consistently seen from administrations prior to him that have tried to do the same thing. He does it in a much more haphazard way, but we are moving in that direction. And so I actually look at our manufacturing base as a strength now and not a weakness, because we're hit rock bottom and we're going to move up from here. So those 4 reasons, among others, are what keep me cautiously and cynically optimistic about the future, and specifically the future of the United States economy. Well, hey, as always, until then, this is John Pugliano wishing you the very best returns.
Did I say that? I can't believe I said that. Next question. Did I say that? I can't believe I said that. Next question. Did I say that? I can't believe I said that. Next question.